I'm going to say something contentious. I think inflation is negative in 18 months.
Okay. Just
I don't think prices fully come back down. They never do. They never mean revert. But I think we will see an unwinding. What you're seeing is what happened 18 months ago.
Hello and welcome to Wealthy Value. In today's video, Real Vision CEO and crypto analyst Raoul Pal updates about inflation turning negative in the coming months, his macro outlook for financial markets right now, and his thoughts on cryptocurrencies, especially Bitcoin and Ethereum. Raoul Pal also addresses the issues of regulator clarity in crypto space and what institutions think about Bitcoin and Ethereum. Make sure to stick around till the end of this video where Raoul Pal predicts when he thinks the markets will bottom and his expectations from the Ethereum merge. If you like the video, don't forget to give it a thumbs up, subscribe to the channel and turn on the post notifications. Let's dive right into the video.
This is how things work. It has to go through the supply chain. So the issue of you not being able to get stuff, and I've got the same issue, can't get stuff, that's 18 months ago problem. The actual problem being faced is who the hell are GM going to sell those cars to?
That's fair. That's the other side.
Right? And at what price? Right. So what we're doing here is we are seeing the tail end of what happened 18 months ago. I think that's going to be dramatically reversed because the supply chain issues are really not as bad. Now, there are issues within commodity markets like oil where we haven't had enough spend. But I don't see a massive increase in demand for oil. Chinese economy is slow. We've got aging populations everywhere. The demand for oil is the 5-year on 5-year rate of change of oil demand is negative. I don't see the demand story. I see a supply story, and there's a lot of people looking at commodity markets going, yeah, oil's going to $200. Yeah, if you can get demand back to where it was, we're assuming it is. And people are extrapolating demand post-COVID, which was a stop of demand, re-release of demand coming back on. That demand goes back down to trend. So I don't see it. So I'm guessing that as oil comes down to $60 or so, as everybody gets washed out now, most commodities are down 50%, so that would be about right, from $120 to $60. How fast does it recover? Well, maybe it recovers reasonably quick because the supply issues, and after a recession, there's a recovery. Are we going to go screaming through $120 and have rates of change that lead to inflation? I just don't see it. Now, the other argument people have is reshoring. Well, reshoring is going to create inflation because we need to build all these factories. I've got as clear a view as I could possibly have. You know, nothing is a certainty, but for me, the macro is rolling over. By that, I mean we're going into recession. We should see the things like the ISM survey and other things start falling apart pretty quickly. The forward-looking elements are falling apart already. We're seeing it globally. So that's growth evaporating. Alongside that, the narrative hasn't caught up. Most commodities are down between 30 and 50%. Oil is the last to crack, and I've been talking about this on Twitter. I've been writing about it for a period of time. Is everyone's long and expecting oil to go to $200. I think there's a washout coming and it goes down to 60. So that's the last inflation story. Everything else from the raw goods then comes into the supply chain and then eventually starts fading. So we're going to see that inventories, because people build massive inventories after COVID. Those inventories are now unsold because of the economy slowing down and inflation eating disposable income. So we've seen it from Walmart, Amazon, and others. They're going to start discounting inventories to try and shift it. People are laying off staff. So the macro cycle is going to get to the ugly phase. Okay, why is that making Raoul bullish? Well, because the outcome to that is as inflation comes down and bond yields fall, liquidity conditions improve. And what drives financial markets at the macro level the most is liquidity conditions. We've just gone through the largest tightening in financial market history because the rate of change of interest rates going up was the fastest ever. Mortgages are back to where they were in 1996, and it's shocking. Then the dollar went up at a rapid clip, which is a tightening of financial conditions, and then commodity prices went up. So basically, everybody's suddenly skint, as an Englishman would say. Nobody's got any money, and the economy implodes. So the forward-looking indicators suggest to me that this goes off a cliff fast until we probably bottom Feb March next year. That's the economy. What we end up with was a position where the big thing that correlates to crypto markets overall is some definition of liquidity, and you can use M2, global M2 year on year. That looks pretty much like Bitcoin year on year, or crypto market cap year on year. We're at the very bottom. It usually turns around at this point because eventually the outcome is central banks have to provide liquidity in a recession because there's no liquidity. So forward-looking assets like crypto are picking it up. So they also have perfectly correlated to the turning points in the inflation cycle. So they kind of time the bottom, and I think it's time the top. So basically, I think crypto is saying, okay, inflation has now peaked, and therefore the marginal pressure from tight liquidity is gone. So my view is, with, let's give it a probability, 70% probability. So that's pretty high conviction that the low is in, and therefore we're starting the upside cycle. So the macro, I think, for me, even though everyone thinks, oh my God, it's terrible, the equities are going to sell off. Well, the equity side of the equation, that correlation with equities was actually a correlation to liquidity. They're all actually correlated to the macro cycle. Can equity sell off further? Yes. Can crypto decouple? Yes. We saw that in March 2020, that crypto started going up when equities were going down because crypto is more forward-looking. However, equities have actually priced in quite a lot already. So it's not 100% clear whether equities need to go down or not. So I did a Twitter poll recently with like 20,000 people responded, which was, do you think equity markets have further to fall? 70% of people thought so. And I said, are you underweight where you typically would be, or in line? And 70% of people are underweight. Well, if 70% of people think the market's going to fall and 70% are underweight anyway, who's left to sell? What happens? So I can see the debate. So the debate is, well, you weren't around in 2018. I've been around since 2013. You weren't around in 2018. 2018, well, goes sideways. Okay, so that's the narrative. I'm like, yeah, but we didn't have this macro backdrop. So I think that's different. Also, we didn't have the amount of institutions and others still coming into the space. It's endless, still happening. So I'm like, so there's demand. And then we've got the ETH merge, and everybody's underweight. And everyone's looking at this resistance in ETH between 1800 and 2000. And everyone's going, well, it's never going to clear that. It's going to go straight back down to the new low. That's possible. I'm not saying it's impossible and that I'm definitely right. But I just think, what if it doesn't stop here? It's just had a pullback. Okay, so ETH has been pulling back from touching those levels, which were the lows in 2021, stuff like that. What happens if this little pullback is just the pause that refreshes and we go blasting through 2000? Okay, now we've got a blind panic, and the people who have to panic first are the hedge funds. Then, once that starts happening, it's the retail. Because the merge narrative will now become a retail narrative. It's going up for the merge, you've got to be involved in the merge. And then you probably have a pullback somewhere around that. That's pretty sharp and nasty because everyone's kind of got in. Mm-hmm. But the institution's going to look at this and go, Christ, we've got a yielding asset, a yielding technology asset that is uncorrelated over longer periods of time to everything else. And we've been doing the work on it for the last 2 years. They all will do it, and they will all do some of it. We know that. So the question is why haven't they pulled the trigger? Well, the price has been falling. These people are generally price takers, not price makers. So you are now going to a situation where, let's say ETH is at 3,000. Mm-hmm. It's going up. Maybe the Nasdaq's going up. People starting to see the bond yields are down at kind of 1.5%. And ETH is yielding 6%, 8%, whatever it's going to start with. This ETH merge is a very, very big deal because of it creates a benchmark yield for the entire Web3 space. This is like everything else can be priced off it. So it can be ETH plus 400 basis points, which is how the world works in traditional markets. I think everything should get priced off ETH. So it'll be
prime rate.
Yeah, so ETH is benchmark, ETH is treasuries. So 1 year ETH is the benchmark rate for Web3. Now we can understand what all risk is, and we can trade spreads. So we can now trade risk more efficiently. Part of the issues we've seen is you didn't know what risks was what. Now we can do that. So institutions love yield. They don't like Bitcoin. They don't like Bitcoin because the ESG narrative, and they don't like Bitcoin because it doesn't yield anything. So now you've got a cryptocurrency that is basically access to a technology of gigantic proportions that pays a yield and has negative supply. So this is basically Google giving you 8% yields and buying back their shares.
So what are your thoughts about Raoul's perspective on Bitcoin versus Ethereum debate? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.